Right traders, welcome back to the channel. Here we have a requested video from some of our internal members at LiquidFX, and this is going to be identifying the next draw on liquidity, right? DOL, or draw on liquidity, right? So one thing to point to is that liquidity is everywhere and we could potentially be drawing lines everywhere, but how do we know as specific price action traders where the next draw on liquidity is likely to be? So before we go into the price, this is the US 30 4-hour time frame, just to let you know. And before we go into the live price action or price action as a whole, this is from 2022. We're going to be going over a couple of schematics just to make sure we understand where we are. So the first thing to understand, and this is something I speak about in every single video, and I'm going to have to mention it here, is that we have our 4 pillars to determining bias, because bias is the most important thing. If your bias is incorrect, there's no way you'll be able to determine the next draw on liquidity. So we have structure, we have our dealing range, we have premium and discount arrays, and we have fair value gaps. So these are the 4 pillars to determining a higher time frame bias. So now that we're going to be dissecting a bearish market, we're going to be looking at what a bearish market looks like from a schematic point of view. So a bearish market gives us lows and higher lows and lower lows, just like this, right? We see a bearish market giving us this overall sentiment, okay? So with the bearish market from here, what we have is we have structural highs and lows, right? We have structural lows, and we have structural highs, and we have structural lows, okay? So the best way to identify a draw on liquidity is to ask yourself, where are the weak structural highs and where are the weak structural lows, right? So let's dive into this in a little bit more detail. Let's take one leg, for example. We have a leg like this. So price rallies down, then price gives us a correction. Price rallies down. So what we've seen over here is we've seen price giving a lower low, and then we've seen price come up giving a higher low. And now from here, we've seen price break structure to the downside, okay? So this break of structure is exactly what we see over here, right? We see a break of structure from bullish to bearish over here. We were bullish, but now we've switched bearish over here. So if we go back to the diagram over here, when we see a break of structure to the downside, right? When we see the break of structure, we need to identify 2 pieces of structure. This is a higher low, correct? But is this a strong or a weak structure? So intuitively, most people understand this because strong structures break the previous structures, right? Strong structures break the previous structures. So this higher low, we can classify as a strong structure, right? This is a strong piece of structure. And the reason why it's strong is because it's broken the previous low to the left. Now you want to ask yourself, this is also a piece of structure, right? This is a lower low. So is this a weak structure or a strong structure? Right, by definition, this is a weak structure. And the reason why this is a weak structure is because you have to understand, if we extrapolate the data back, what we saw is we saw price in a downtrend, right? So from here, we understand that this is the low and this is the last high. This is the last higher low up here. So you want to ask yourself, has this lower low broken the last previous low? Well, the answer is no, because we're in a downtrend, right? Understanding market direction is key. So we're structurally bearish. We're about to produce a bearish dealing range. We've come off a premium, so we've reacted off a premium, and we've reacted off some kind of fair value gap. So we've determined our market bias and our market direction. This now is a weak structure, and a weak structure is what we target, and a targeted structure is the next draw on liquidity. So a draw on liquidity, like the name suggests, is simply where we are expecting the market to go, or in other words, where we are expecting the market to target next in terms of liquidity. So you want to ask yourself, yes, this is a weak structure, but what is beneath a weak structural low? Well, the answer is liquidity, right? This is where the word liquidity comes from, right? It's the next liquidity pool that's likely to be targeted, and that's the next draw on liquidity. So when you're in a bearish market, you need to understand where the strong structures are and where the weak structures are. And a strong higher low, or a strong high in this case, breaks the previous low. Very, very important to understand that. So now if we take this idea and take it to the charts, what we see over here is we see price producing a low and a high. Now from here, this high is a strong structural high. So let's break this down into more detail. Let's zoom into the price action. The previous low to the left of your screen is just over here. So this is the previous lower low. Now from here, we see a high over here. This is a higher low over here. Now, is this a strong structure or a weak structure? Strong or weak? Just by looking at the current market climate. So from here, we understand this is a strong structure because it's broken the previous lower low. And so from here, this now becomes a strong structure and our higher low. So this is what we call a protected high. This is a protected high. And the reason this is a protected high is because it's broken the last low. And so by definition, this now becomes a weak structure. And what did we say about weak structures? A weak structure is essentially a targeted piece within the markets. A weak structure is a targeted piece in the markets themselves, okay? So from here, what is the next draw on liquidity? The next draw on liquidity is this low over here. And the reason why this low is the next draw on liquidity is because it's the targeted low in this case, right? This is a low that hasn't broken the previous high and therefore is a target. So from here now, of course, price broke structure to the downside and that low was targeted. So from here now, we apply the same rules again. Let's look at this dealing range. Structurally, we are bearish, okay? We've had a break of structure to the downside again. So you want to ask yourself now, this is our dealing range. This is our structural dealing range. It is a bearish dealing range. Let's use the Fib tool from the Fibonacci, using the Fibonacci from the swing high down to the swing low. Now, this is a high that's broken the previous low. The previous low is down here. This is the previous high. This is a strong market structure. This is strong. And the reason why is because it broke the last low. Now, when we break the last low, we understand this is a protected high. And this now becomes, because it's broken the previous high. So now we need to look at this low over here. This low came up into a premium. So we understand price came into a premium above that 50% level. We've reacted off some fair value gaps over here to the left. We've reacted off some fair value gaps. And now you want to ask yourself, what is this low produced? What is it broken? What is this low broken? Ask yourself, everyone. Pause the video and write this down. What has this low broken? This low has essentially not broken anything because the last high in the market structure is all the way up here. This high only came here. So imagine now once we've seen the bears kick in, we see bearish price action kick in over here, supply takes control of demand. This now becomes the next overall liquidity draw. This low down here. So this low becomes the next overall liquidity draw. And hence it was targeted, right? A couple of things you can also consider when it comes to the next draw on liquidity. Again, what we have over here is we have a trend line. Again, a trend line near a weak structural low is like dynamite. That's a very high probability draw on liquidity. Of course, we can never be completely correct. But again, coming back to the overall schematic that we had, the four most important things: structure, dealing range, PD arrays, and fair value gaps. These are by far the most important four things you need to understand in your trading, regardless of how you trade. Understand the market structure, the dealing range, the premium and discount arrays, and the fair value gaps. This is what allows us to identify the next draw on liquidity. So to identify the next draw on liquidity, again, let's continue this exercise one more time. Again, let's now choose a bullish example, right? So from here, we saw a shift of market structure. So we've identified the 2022 bear market, right? The stock market was bearish in 2022. And so from here, we've had a shift of structure going into the end of 22, going into 23. So again, just by looking at the market structure over here, what happened is we saw price break structure to the upside. So we had a structural break over here, boss. Yes, we had a retracement down here. It was a fairly shallow retracement. I think, did it go into premium? Let's have a look. Yes, we've just come into discount. I'm sorry, not premium, discount. We've just come into discount. We've tapped into a discount zone. We've mitigated a fair value gap. And when we see price heading up higher, right, when you're in this region over here, you want to ask yourself, the next DOL, the next draw on liquidity is this region over here. Because you have to ask yourself, what is this high actually done? What has the market done with this high, right? Yes, this high drove price lower into a discount. But when we see price in this region over here, you want to ask yourself, has this draw on liquidity, has this high, broken the previous low? Well, no, it hasn't. Boom, it gets targeted. Again, we just follow the same scenario with the bullish market as we did with the bearish market, right? So if there's one thing you took from this video, it's the importance of understanding, determining a bias, which I've made plenty of videos on, structure, dealing range, PD arrays, and fair value gaps. And to determine the next draw on liquidity, the golden question is, where are the weak structures? Ask yourself this question, and more often than not, you'll be on the right side of the fence. if you understand market direction and if you understand the concept of weak versus strong structure. So if you like this video, give it a like and thumbs up. Again, we're offering free one-to-one sessions at Liquid FX. So you can book through the YouTube channel, you can book through Twitter, you can book through Instagram, you can book through directly emailing me at lickstat@gmail.com. I'll repeat that, lickstat@gmail.com. Anyone is interested to take their trading to the next level, we have a free Discord, we have a free ICT guide, we have lots and lots of content just to simplify the ICT and SMC style of trading, and I look forward to seeing all of you in the next one.